When you're saving for retirement, one of the key decisions you'll encounter is choosing between a Roth account and a traditional account.
And if those terms feel confusing, you're in good company. Most people hear them often, but aren't always clear how they work.
I'm April with White Oak Planning.
And I'm Jerry. Today we're explaining differences between Roth and traditional accounts so you can better understand how each one works.
So let's look at the core difference. The main distinction between Roth and traditional accounts is when the money is taxed.
With a traditional IRA or 401k, contributions are generally made with pre-tax dollars if you're eligible to deduct them. Withdrawals in retirement are taxed as ordinary income, including both contributions and any gains from investment growth.
With Roth IRAs and Roth 401ks, contributions are made with after-tax dollars. Withdrawals that meet IRS qualified distribution rules, such as being 59.5 and having met what is known as the 5-year rule, are tax-free.
So the difference is tax-deferred growth with traditional accounts versus tax-free qualified withdrawals with Roth accounts.
Many people compare tax rates today with what they expect later, but it's important to note that future tax rates are unknown and may change.
Traditional accounts allow a potential tax deduction today if you qualify. Whether you can deduct a traditional IRA contribution depends on income, tax filing status, and whether you or a spouse participate in a workplace retirement plan.
Roth accounts do not provide a tax deduction today. Whether you can contribute to a Roth IRA depends on IRS income limits that phase out at certain levels each year.
For example, the IRS uses income ranges to determine Roth IRA eligibility. Being in a particular tax bracket does not automatically mean someone qualifies to contribute.
Let's go through a few educational examples. General, they're for illustration only. These are not recommendations. Some people contribute to Roth accounts earlier in their career, especially if they happen to be in a lower tax bracket. Again, eligibility depends on income limits set by the IRS.
For example, a worker earning wages that place them in the lower IRS tax brackets, such as 12% or 22%, they may choose to use a Roth account if they're eligible. But eligibility for a Roth IRA depends on modified, adjusted gross income limits, not the tax brackets alone.
Others use Roth accounts because qualified withdrawals don't increase their taxable income in retirement. This can affect things like Medicare income-related adjustments or how Social Security benefits are taxed, depending on the rules at that time.
Traditional accounts are sometimes used by individuals in higher income brackets who qualify for the tax deduction. For example, someone whose income places them in a higher marginal tax bracket may find the current year tax deduction meaningful if they meet IRS deductibility rules.
Whether someone ends up in a higher or lower tax bracket in retirement varies widely and depends on income sources, spending levels, tax law at that time, and other factors.
All right, let's talk about some tax saving examples. If someone contributes $5,000 to a traditional IRA and is eligible to deduct it, the tax savings depends on their actual marginal tax rate. For illustration, someone in a hypothetical 24% tax bracket could reduce their taxes by $1,200. Actual results depend on each person's personal tax bracket and eligibility.
And we often get asked, can we use both? Some people do choose to use both Roth and traditional accounts. This is often referred to as tax diversification, and it simply means having different account types that are taxed differently.
For example, some people contribute to a traditional 401k through their employer and also contribute to a Roth IRA if they're eligible based on income rules.
Others split contributions between traditional and Roth within the same 401k plan if their employer offers both options.
Having different account types may give retirees flexibility when choosing which accounts to withdraw from, based on their taxable income at that time and the tax rules in effect.
Let's also look at an educational overview about Roth conversions. A Roth conversion is when money is moved from a traditional IRA or 401k into a Roth account.
When this happens, the amount converted is generally taxed as income in the year of that conversion. After that, the funds grow tax-free in the Roth account subject to the IRS 5-year rules.
Some people consider conversions in years when their income is temporarily lower, such as a sabbatical or the period between leaving work and taking retirement income.
This is simply how the mechanics work. It's not a recommendation. Conversions can affect taxes, Medicare premiums, and other financial areas, and do require careful analysis.
As always, we'll bring in blended family considerations. In blended families, each spouse may have retirement accounts with different tax characteristics.
Coordinating account types across the household can help couples understand how withdrawals may affect their combined taxable income in retirement.
It's common for spouses to have different employer plans or different eligibility for certain contributions.
Understanding the tax characteristics of each account type helps families plan intentionally.
A helpful first step is simply identifying which type of account you're currently contributing to: traditional, Roth, or both.
Next step, review IRS rules about contribution limits, income limits, and withdrawal requirements to understand how those apply to your situation.
If you want to explore how account types fit into your broader retirement picture, you can schedule a complimentary Connect call using the link below. I'm April with White Oak Planning. If this helped you understand the differences between Roth and traditional accounts, subscribe. And would you consider paying it forward by sharing it with someone who may benefit from this information?
And I'm Jerry. There's no single account type that's right for everyone. Understanding the rules helps you make informed decisions. I'm Jerry, and we're White Oak Planning, helping blended families make sound financial decisions.